September 15, 2008. Before sunrise, employees walked out of Lehman Brothers headquarters carrying cardboard boxes. Just hours earlier, they worked for one of the most powerful investment banks in the world. Now, after 158 years in business, the company was bankrupt. Within hours, stock markets fell, banks stopped trusting each other, and a financial crisis began spreading across the globe. But how did one company trigger one of the worst economic disasters in modern history? The story began in 1850 when three brothers opened a small general store in Alabama. Farmers often paid with cotton instead of cash, so the brothers started trading cotton instead of simply selling goods. Their business expanded, moved to New York, and eventually became Lehman Brothers, one of Wall Street's biggest investment banks. By the early 2000s, it managed billions of dollars and was considered one of the safest names in finance. At the same time, America's housing market was booming. Home prices kept rising, and banks approved more mortgages than ever before. Instead of keeping those loans, banks bundled thousands of mortgages together and sold them to investors as mortgage-backed securities. As long as homeowners made their monthly payments, everyone earned money. It looked like the perfect system. Lehman Brothers invested heavily in these securities. The housing boom created record profits, and confidence spread across Wall Street. Investors believed home prices would continue rising forever, but they were wrong. Interest rates increased, making mortgage payments more expensive. More homeowners began missing their payments. At first, the problem seemed small, but it quickly grew. As defaults increased, the mortgage-backed securities that banks believed were safe started losing value. Billions of dollars disappeared almost overnight. In March 2008, another investment bank, Bear Stearns, nearly collapsed. It was rescued, but investors began asking an uncomfortable question. If one major bank could fail, who would be next? Soon, all eyes turned toward Lehman Brothers. Its stock price fell sharply as confidence disappeared. Executives searched desperately for new investors and buyers while government officials held emergency meetings throughout the weekend. Everyone hoped a rescue deal could be reached before financial markets opened on Monday. It never happened. On September 15, 2008, Lehman Brothers officially filed for bankruptcy. It was the largest corporate bankruptcy in American history, involving more than $600 billion in assets. Television stations interrupted regular programming as employees quietly left the building carrying cardboard boxes. Those images became symbols of the global financial crisis. The impact was immediate. Stock markets crashed across America, Europe, and Asia. Banks became afraid to lend money because no one knew which institution might collapse next. Businesses struggled to borrow money, companies laid off workers, families lost income, and millions of people who had never heard of Lehman Brothers suddenly found their lives affected by its collapse. Governments and central banks stepped in with emergency rescue programs to stabilize the financial system. New banking rules were introduced, oversight became stricter, and financial institutions were required to hold more reserves. The collapse of Lehman Brothers changed the financial world forever. Its biggest lesson wasn't just about banks or mortgages, it was about trust. The financial system depends on confidence. Once that confidence disappears, even the largest institutions can collapse with shocking speed. Lehman Brothers survived for more than a century and a half, yet it fell in only a few days. More than 15 years later, one question still remains: have we learned from 2008, or are we quietly building the next financial crisis?